Welcome to the video. First, we will set the stage on how HSAs work and why your spouse's FSA could unexpectedly disqualify you from contributing. Next, we will walk through the rules, the crisis when mistakes happen, and the exact steps to fix them before penalties hit. Finally, we will wrap up with examples, a quick quiz, and practical takeaways you can use right away. Before we begin, it is important to clarify that this content is educational and not tax, legal, or financial advice. Additionally, your employer's plan documents, your spouse's plan design, and your tax situation may create exceptions or special cases. Therefore, you should verify your details with your HSA custodian, your benefits administrator, and a qualified tax professional before taking action. Here is our agenda for today. First, we will review HSA basics and define the spousal FSA trap. Next, we will cover what happens when you contribute while ineligible and why that creates excess contributions. Then, we will go step by step through removing those excess amounts. After that, we will discuss the tax consequences and deadlines. Additionally, we will explore edge cases and exceptions. Finally, we will check your understanding with a quick quiz and close with clear takeaways and next steps. Let's get grounded. HSAs require coverage under a qualifying high-deductible health plan and no disqualifying coverage. The triple tax benefits are contributions not taxed, growth not taxed, and qualified withdrawals not taxed. However, a general-purpose FSA that your spouse enrolls in is typically allowed to reimburse the family's medical expenses. As a result, that FSA becomes disqualifying coverage for you, which means you are no longer eligible to contribute to an HSA. This disqualification can occur even if you personally never use the spouse's FSA. Now let's highlight the core risk. When your spouse enrolls in a general-purpose FSA, that election usually allows reimbursements for eligible medical expenses incurred by the employee's spouse, and dependents. Therefore, even if you do not submit claims, you are considered covered by disqualifying coverage for HSA purposes. Consequently, any HSA contributions for months when that FSA coverage applies are excess contributions. Because FSA funds, once elected and used, generally cannot be unwound, the IRS requires you to fix the issue by removing the excess contributions from the HSA. Timing can make or break the outcome. During open enrollment, you should coordinate elections and confirm whether your spouse will have a general-purpose FSA. At the start of the plan year, double-check eligibility before continuing HSA payroll contributions. If your spouse enrolls mid-year, you should stop HSA contributions as soon as possible for the months of FSA coverage. Finally, before the tax filing deadline, request removal of the excess contributions and associated earnings to avoid the excise tax, and then report appropriately on your return. Here are the steps to correct the issue. First, contact your HSA custodian and request a removal of excess contributions. Next, ensure the distribution includes both the excess contribution amounts and the earnings attributable to those excess funds. Then, stop any additional HSA contributions for the months you are ineligible. After that, expect a distribution form from the custodian, often a Form 1099-SA, and be prepared to include the removed amounts as income to reverse the original deduction. Finally, complete these actions before the tax filing deadline to avoid the 6% excise tax on the excess. This matrix compares common scenarios. In a general-purpose FSA, the spouse's coverage typically extends to the family and disqualifies HSA contributions. In contrast, a limited-purpose FSA, which reimburses only dental and vision expenses, does not disqualify HSA eligibility. A post-deductible FSA that only reimburses after the HDHP deductible is met can also preserve eligibility. If the spouse enrolls mid-year in a general-purpose FSA, you generally may contribute only for the months before that coverage started, which means prorating. Finally, if there is a general-purpose FSA carryover into the next year, and it is not limited purpose, eligibility remains suspended until the carryover is exhausted or the plan restricts it to limited purpose. Let's cover the tax consequences. If you remove the excess contributions and the associated earnings before the tax filing deadline, usually April 15th, you can avoid the 6% excise tax. However, the removed amounts, including earnings, are included in your taxable income, which reverses the original tax deduction. Your HSA custodian will typically issue forms, such as a 1099-SA, reflecting the distribution. Although your W-2 of may still reflect the original payroll contributions, the removal and income inclusion reconciles the error on your return. If you miss the deadline, a 6% excise tax may apply each year the excess remains until it is removed. Question: if your spouse enrolls in a general-purpose FSA that can reimburse family medical expenses, what happens to your HSA contribution eligibility? Option A: nothing changes. You may keep contributing to your HSA. Option B: your HSA contribution limit is reduced by your spouse's FSA amount only. Option C: you become ineligible to contribute to an HSA for the months covered by the spouse's FSA. Option D: you can contribute only if you do not submit any claims to the FSA. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that you become ineligible to contribute to an HSA for the months covered by the spouse's general purpose FSA. Because that FSA typically extends to the family, it is disqualifying coverage for HSA purposes, which means your contribution limit is effectively zero for those months. Question: by when should you remove excess HSA contributions and earnings to avoid the 6% excise tax? Option A: by December 31st of the contribution year. Option B: by the tax filing deadline for the following year, usually April 15th. Option C: anytime within 3 years with no penalty. Option D: only if you received employer HSA contributions. You may pause the video now to consider your answer. We will discuss the answer in the next section of the video. The correct answer is by the tax filing deadline for the following year, usually April 15th. Completing the removal by that deadline avoids the 6% excise tax. Note that you will still add the removed amounts and the associated earnings back to your taxable income. Let's consider common exceptions. A limited-purpose FSA, which restricts reimbursements to dental and vision, does not generally disqualify HSA eligibility. Similarly, a post-deductible FSA that reimburses only after the high-deductible health plan's deductible is satisfied can also be compatible. Dependent care FSAs do not affect HSA eligibility because they are not medical coverage. On the other hand, general-purpose FSA carryovers can continue to disqualify eligibility unless the plan explicitly converts the carryover to limited purpose. If your spouse enrolls mid-year in a general-purpose FSA, you may prorate your HSA contributions for only the months that were eligible before the FSA coverage began. To avoid issues, coordinate elections during open enrollment so the FSA type aligns with HSA eligibility. Here are the key points. First, HSA eligibility requires qualifying HDHP coverage and no disqualifying coverage. Second, a spouse's general-purpose FSA usually disqualifies you from contributing, reducing your contribution limit to zero for those months. Third, excess HSA contributions must be removed, along with earnings before the tax filing deadline, to avoid the 6% excise tax. Fourth, the removed amounts and earnings are included in your taxable income, reversing the initial deduction. Finally, coordination during open enrollment can prevent problems, and limited purpose or post-deductible FSA options may preserve HSA eligibility. To solidify the core ideas, here is a compact recap. The simplest way to remember this is that if your spouse has a general-purpose FSA, your HSA contribution limit for those months is zero. For the removal process, request a removal of excess contributions, include the earnings on those excess amounts, meet the deadline by the tax filing date, and report the income add-back as required. Finally, note that limited-purpose and post-deductible FSAs can be compatible with HSA eligibility. In summary, identify the spousal FSA trap early so you do not accidentally contribute while ineligible. If you discover a problem, stop contributions immediately and request removal of the excess and the related earnings. Act before the tax filing deadline to avoid the 6% excise, and remember to include the removed amounts and earnings in taxable income. Finally, coordinate open enrollment decisions between spouses to keep your HSA strategy intact. Thank you for watching. Before we end, please like this video if you found it helpful, share it with someone who could benefit, and subscribe for more practical guidance. Additionally, let us know your questions and experiences in the comments, and we may feature your scenario in a future episode.